just few months after we sold our company DailyDeal to Google. I have actually had one severe burnout, and I came to a point where I couldn't get out of bed in the morning. Basically, I got into the worst crisis of my life because I realized that I had lost my entrepreneurial freedom and my ability to design and to drive things forward.
How do you find happiness while watching the world burn?
I've developed basically a daily routine that helps me sustain high-level performance, but at the same time also physical and mental health. This routine is basically composed of a daily physical workout, first thing in the morning, plus a several times daily meditation routine.
How do you pronounce AENU?
AENU is indeed our own creation, and it's all phonetically about the new thing, the new era, the new day. So it's a new era of impact venture capitalism.
Welcome to the Climate Insiders podcast, where top climate thinkers, entrepreneurs, and investors share revolutionary ideas and insights. Tune in to learn from the visionaries shaping a sustainable future. Let's dive in. Fabian, welcome on Climate Insiders.
Johan, my pleasure to be on air with you today, and look forward to the next 45 minutes.
Right. I've been looking forward to that one. A great respect for you, and there's a number of questions that everyone, is curious to hear the answers on. So once and for all, how do you pronounce AENU?
So AENU is indeed our own creation, and it's all phonetically about the new thing, the new era, the new day. So it's a new
AENU.
Like a new era of impact venture capitalism.
Wow. Did you come up with this on a Burning Man retreat or something like this? Just lost in Norwegian forest?
Actually, I came up with it in Portuguese forest in Alentejo coast, where I like to spend most of the vacations within the restrictions that you have when you have children in school age. And for us, it was really about finding a brand that goes beyond our day-to-day business of raising and deploying capital, but it's also a bit, alluding to the contributions we would like to make to systemic change when you think of capitalism transformation from the classical, let's say, financial, liberal capitalist system the past 250 years towards what we like to think of as impact capitalism that has a broader definition of success, a more stakeholder-centric approach. And all of this is, let's say, incorporated in the brand AENU.
I see. You come from you were telling me, professional surfing, to starting multiple companies in different fields, to becoming a VC investor, and now running a climate tech VC. So how do you avoid burnout from all this? Is there a key here, or just the eternal flame inside of you keeping you going?
Good question. So first of all, let's say on the positive side, I believe I was blessed with, let's say, a fairly high energy level and also with a high drive. And this combination has, let's say, I'm 41 years old right now, has manifested.
It's a good age.
It's a good age, yeah, exactly. Maybe half, maybe a third. Let's see. Longevity of my life has passed, and this has manifested basically in different fields over time. You spoke about it. I was first pursuing an athletic career, then went through law school, and then I was many years on the entrepreneurial side, on the operational side of the table before then going into VC and making this my focal point or sole focus today, and then going from generalist to climate impact VC. But more specifically to your question, I mean, I have actually had one severe burnout and maybe one smaller one in the past 10 years. And funnily, the severe one occurred just few months after we sold our company back in the day, B2C marketplace DailyDeal, to Google, which, let's say on the surface, back in those days, in a definition of success that was really more about shareholder value and enterprise value and revenues and
it still is
jobs. It still is, but not only, right?
Right.
At least for me or for us. And back in those days, this was basically the what we had achieved with this trade sale, had raised from inside and sold to Google. This was basically, so to say, the pinnacle of success of how the ecosystem back in 2011 or 12 was thinking about success. And yet right after, basically I got into the worst crisis of my life because I realized that I had lost my entrepreneurial freedom and my ability to design and to drive things forward. I was basically degraded from entrepreneur to manager to administrator. And this was so in a negative way impactful for me that all of the, let's say, all of the success that it yielded in a financial sense or market profile and whatnot was completely overshadowed, and I came to a point where I really literally couldn't get up anymore and couldn't get out of bed in the morning. Yeah.
Wow, that's something that resonates for sure.
It does.
When people or the organization puts you in a cage, if your nature is to be endlessly curious and to explore, you feel completely contained, and you need to, enrage or find a kind of energy to take yourself out. And how did you go from entrepreneur to VC? Was it just a natural path for you, or is something that you regret somehow? You still remain a founder, entrepreneur at heart, or VC is more suited?
I consider myself today as an entrepreneur in climate impact VC, and not as a traditional investor or career investor by upbringing and by DNA indeed. For me, having always worked very closely with my brother, Ferry, who's also the other founder of AENU, and with whom I've co-founded 5-6 companies even since 1999. So we really started in teenage years, like in our small like hometown, home village near Hanover, Germany, really like country boys. Yeah. When we after we had sold our company to Google, we came to a point where we said we would like to diversify our activities and also collaborate, but not stepping each other on the foot. So we decided that Ferry would then take the operational co-founder CEO roles in the companies that we founded subsequently, including Localize, and we did pepperbill, and later also Forto 2016 that jointly with our co-founders Mike Wachs, Eric Muttersbach, that turned into a logistics tech unicorn, then funded by SoftBank in 2021. And I would branch out and start reinvesting these Google exit proceeds as an angel, kind of super angel, make the beginner's mistakes with our own money for 2.5 years, in order to then step up into the institutional VC business, either organically or, and that was then the opportunity that arose back in the days, also already based on a few years of deal-by-deal co-investing and us being LPs in early bird funds. The opportunity arose for us to, with our small team of just 3 people, to basically join forces with early bird and the founding partners, and basically take it to the next level, pan-European early stage investing and really learning the institutional VC craft.
So since I'm glad you mentioned your track at early bird. It's funny that you enter as an LP into the fund, which is a bit of an unusual move to become a GP. Maybe you can speak to this. Is this kind of where more successful entrepreneurs should go in the VC route? And tell us also the genesis of AENU, which is it seemed like it started at a family office. You and your brother coming together and saying, hey, we want to allocate a lot of this capital into climate. Let's just start with our own pockets and then explore how we can bring on board institutionals.
Right. So, I mean, generally, first of all, to the first part of your question, I think, indeed, I mean, typically when you see experienced CEOs and serial entrepreneurs transition into venture capital, there's 2 routes. Either you join an existing firm. Many then do this with the ambition of also, let's say, bringing their own DNA into it and influencing the culture, potentially the strategy, maybe even setting up a specific pocket or a specific practice where they specifically relate to. The other way, the other option is to go organically, typically from microfund or solo GP these days, and then stepping up into a more institutional operation. In our case, both was an option. And the opportunity then to work with Hendrik, with Christian, the founding partners at Early Bird, arose, we seized it. And I was then subsequently partner, also then became youngest general partner at the firm, was around that role for 6.5, almost 7 years. And during that time, while my brother in parallel scaled Forto, our the latest company we founded in 2016, during that time, a very profound, let's say, transformation started for my brother and myself almost simultaneously, where we got to basically to ask ourselves the question how our professional actions or our business conduct relates in the bigger context. And if we look back from age 60, 70, 80, 90, hopefully at some point, what stays? And how have we utilized our talent, our resources, our material, immaterial assets in a way that they contribute in a grander societal and or planetary context. And that journey initially certainly also was sparked by by the book 10 Billion, Stephen Emmett, but also Al Gore's publications. Certainly, this got us going, and pretty quickly for us, the climate crisis was kind of the central kind of hinge and the central thing for us where we related to and said, let's see if we can make a contribution here. And we started really in concentric circles by looking at our consumer behavior and calculating footprint for our lifestyles essentially, and said, okay, well, what can we optimize? And so we turned vegetarian and sold sports cars and almost entirely stopped long distance flying and started procuring renewable electricity for our private homes and reduced our footprints by 30, 40, 50% within just like 2 years. It's just behavioral change. And it's a bit, say, here and there, maybe a bit of sacrifice, specifically on the air travel piece. I was a pilot myself at a small aircraft, tried to get sustainable fuel, couldn't, so stopped. So yes, there was an element of sacrifice, but overall, let's say our lives improved and also became healthier through this awareness that we were shaping from a climate angle. It wasn't even yet from a health angle or animal welfare angle so much. Speaking, for example, of becoming vegetarian. Yeah? And then we went on and asked ourselves, okay, this is 10 tons, 20 tons, 50 tons, where are the hundreds, thousands, or tens of thousands of tons that we can help save or at some point even remove, speaking of what we do today also on carbon removal with AENU. And so we went into company carbon footprinting, self-taught, and looked into Forto, a company we could control, and also early bird portfolio. There were some companies that were interested in learning more. And this is how ultimately then 2018, early 2019, Leaders for Climate Action emerged as a nonprofit organization. LFCA that we co-founded with a handful of friends here from the Berlin ecosystem. Some are today also VCs, others are operators. And we put a certain amount from our private wealth to also help get it going. And today, with like 7 people full time at about 1,700 companies who joined this movement, who run the measurement, who give pledges, who also report back and share best practice in this community of climate conscious tech companies. It has come quite a far. And then, naturally for us, where is the bigger lever or the next bigger lever? The question was, how can we integrate climate impact with our core business? And that was at the time building a logistics tech company and doing generalist VC investments in early stage in Europe. And so the next step was to start a climate tech investment practice for Earlybird to also actively invest in early stage new technology development that would relate to positive climate outcomes specifically, yet not in a charity or non-profit, but in a for-profit regime with the ambition to generate venture-grade returns. And once that step was taken, for me, basically this inner, let's say, conflict started of whether I'm happy to do this as, let's say, a satellite operation, and the same for Ferry, who was always a venture partner at Earlybird and CEO at Forto. I was a co-founder chairman at Forto, but the general partner at Earlybird. So it was always kind of this crossover, let's say, family operation, you could say. And we then started wrestling kind of with ourselves, and then specifically Ferry from 2020 onwards started putting angel investments in the space, and did that 2020, 2021, which later then became the AENU pilot set of 12 companies, including the likes of Monta from Denmark, big showcase today in EV charge point operation, or Zero Avia, and one of the global leaders actually in hydrogen electric aviation powertrains, or Minimum and API-driven carbon accounting. NEA came in after us. And ultimately this led for us to the point, and to your question, how did you go about it? Step by step. So this AENU pilot, indeed, this was basically private money from the partnership that was used to demonstrate a strategy of a potential later institutional grade Article 9 climate impact fund. And then in 2022, we came to the point where we said, we want to make this a sole and focal point of our lives and a major point of our private capital allocation. And we want to live in a setup where the strategy we invest and where we devote 10 or 12, 15, sometimes 16 hours a day to is 100% aligned with the philosophy or point of view we have on the world, and how technology should become or should be part of the solution, specifically related to the climate crisis, and how we also felt that we could make with our tangible and intangible assets the best possible impact. And this was essentially the starting point for AENU as an institutional fund. And then what happened in the last 2 years is basically a ramp up from, a family office operation to a team of 13 people, 3 colleagues on the in-house impact team, and a mix today of European institutional LPs and also many single family offices, a couple of prolific entrepreneurs that count to our LP base. And this is where we are today.
So you've been in the grind of entrepreneurship, and which is not the norm in VC. Most VC fund managers do not come from founding background. They come from pension fund, banks, consulting. Do you wish most VC funds were coming from as founders?
Looking to make smart investments in climate tech? Subscribe to the Saturday Climate Insider newsletter. Every Saturday, I'll send you one actionable tip to navigate the climate tech investment landscape. Join over 3,500 investors who are already gaining exclusive insights and strategies. Subscribe today.
I know that in the US, indeed, the ratio of former operator VCs is much higher than in Europe. In Europe, as you say, many people come from investment banking, consulting, or let's say career investor backgrounds. I believe, to be honest, that there's no right and wrong. And I believe that many ways are leading to Rome. And
that's a very politically correct answer.
Well,
what do you think deep inside?
I think of it more from board composition. Mm-hmm. So when our customer is not the LP, our customer is the founder, is the entrepreneur, or is the entrepreneurial team, and specifically the CEO of a company. And the answer, what is right or wrong, or many ways indeed leading to Rome, should, from my point of view, not be answered in a theoretical manner, but should be answered from a value contribution or value add perspective to the founder. And I can say, for our own companies, we raised from Insight, we raised from Northzone, from SoftBank, etc. Yeah, and I have seen the full spectrum from former serial entrepreneurs all the way to people who have never been in a different role, who started out as an analyst and are today partners or general partners in firms. And I have seen different skill sets at work. But both types can be very value additive and very good investors. And therefore, again, coming back to this point, for me, it's always about syndicate composition and board composition. And I think a good board, and with a good board, I mean a board of 4 to 6 people, not of 10 people. A good board should have both. Because it's complementary and because it provides in the spirit also of diversity of board DNA, it provides complementary angles to the benefit of the founders. And that's even true when we think of deal team composition. So if a firm like AENU works with 2 people deal teams, ideally also there you don't have redundant DNAs, but you have complementary DNAs of these 2 people, typically one more junior, one more senior. And this is my answer. So I don't believe in right or wrong, and I also don't give the advice when younger VC professionals ask me, can I become a successful, mid-long term, can I be successful in a VC career unless I haven't started my own company? I would say absolutely you can. It is a matter of your DNA, and there are so many. Quoting here, for example, my former early bird colleague, André Retterath, who's arguably probably one of the best AI investors, at least in the German-speaking ecosystem, is technically a career investor, but he's so strong, so good at what he does. Yeah, and same was true, for example, for Brad Tuick, Insight, and then be partner at Lightspeed, etc. Outstanding.
And what makes a great VC? I would love to get your opinion. What makes receiving an investment from Breakthrough Energy, Union Square Ventures, Index Ventures better as a startup than the average VC?
So again, putting myself in the founder's shoes where I've been for quite a while, essentially there's 2 things that you buy from a VC. And the one is the firm brand, and that can be Breakthrough, can be Excel, Index, NEA, whatnot, General Catalyst, that radiates to your firm brand, as in to your operational company firm brand, yeah, and that influences your employer branding, that also influences attractiveness, or let's say the interest that other VCs might show in your asset. It might influence the confidence that certain, especially in the B2B area, that certain large enterprises have in working with you and trusting that you're not going to go out of cash tomorrow during your POC partnership. And then there's basically the personal brand of the deal team, the deal partner, and potentially its wing woman or wing man. Yeah, and I believe that with larger, more established firms, founders tend to often buy more into the firm brand. Yeah. Whereas with emerging managers, the firm brand is not yet as strongly established in the market. And if they win a deal, they often win it based on the personal brand or the personal interaction and the value add that is also showcased by the deal team already pre-investment during the, let's say, engagement phase, not yet marriage phase. Yeah. And ideally, in an ideal world, both is strong. Ideally, as an entrepreneur, you relate and see benefit and value in the firm brand and also in the deal team brand. But if I had to choose, in hindsight, I would always give higher weight, maybe 60-40, 70-30, to the deal team and to the personal fit, to the trust, to the evidence also for the value add of the deal team.
As a founder?
Compared to the firm brand.
Interesting. And who do you look up to? Who are your role models then as personal brands in the VC space? Which top investors inspire you and why?
Good question. Honestly, I can't give an answer to it because I believe very few, let's say, mid-long-term success stories have been built on imitating or trying to imitate the success of others. And like in surfing, where it's about finding your line on the wave. Yeah. I always had the same approach to my entrepreneurial career and also to my career as an investor, most lately now, and also certainly as my end game with AENU. Certainly, there's some elements that other people are strong at, and you see some investors who are just geniuses of of pinpointing certain thoughts in a very pronounced way and making sense of industries and thesis in a way that is conveyed very strongly and are really strong in their social media presence on blog, on LinkedIn, on Twitter. There's others who just excel on the board work and in the day-to-day, operational collaboration with the entrepreneurs and are very responsive and both operationally but also strategically. strong. There's so many, let's say, different shades and elements of investor DNA that ultimately compose a great investor. There's not a single individual I could quote. But certainly what intrigues me is going beyond, let's say, the established mode of venture capital of the past 40 and 50 years, because this mode has always had certain structural deficits from my point of view, and one being the lack of impact in the way they define success by purely looking at the financial returns within legal frames, but without having any ethics, any value attached to it, and even being ready to fund fast commerce and addictive social media, gaming, gambling companies, as long as they make money. Yeah, this is an idea that we reject, and where our definition of success at AENU encompasses both, of course, the planetary aspect, but also the societal or human aspect. And another deficit, and I saw you had Jacqueline here from Carbon Equity, also a company we supported as angel investors. Another big deficit of the industry is its exclusivity, in a way that the capital intake has always been, this is also a regulatory question, of course, not just mindset of the GPs. The capital intake has always been limited to people who are already very wealthy and to institutional investors. So you could also say, in other words, a lack of democratization.
Right.
Where we have also been doing some structural work on it, and we believe the time is not yet there for really structurally democratized VC funds per se, but the layers like Carbon Equity or Moonfair are getting closer, and there's regulatory work to do. And ultimately, one of the dreams I have when we look 5-10 years down the line is for every young professional that is impact-minded to be able to invest in well-performing climate impact VCs, just like they could do. High
five. Exactly what I'm working on with Climate Insiders. We're trying to provide any professional that is working, and I'm frightened by the amount of people that do have all the tools. They work in VC funds to not be able to develop their own personal track record. They do have the capital. They know how the deals are done. They do have access, and yet they're not able to invest, partly out of fear and also out of conflict of interest. There's something that we need to wipe out. There's a lot of hypocrisy, let's say, in this field, where we do want to move forward as much as possible as a collective and momentum on the impact front, but we seems like we're cutting the grass under the feet of most of those professionals, saying, no, because there's LP money on the line, so you will not be able to invest your own capital. Are you in favor of just wiping out all those conflict of interest, or saying the impact is what really matters? So the more the merrier, the tide rises all boats.
Overall, this is the spirit in which we are working, and this is also, for example, I mean, this collaborative approach, this collaborative idea that's speaking behind this idea of the tide is rising, all boats. That is also the reason why, for example, we have been open sourcing our impact methodology and frameworks to other GPs, to the broader public. In an effort to contribute to the inspiration of other managers to also move from an SFTR Article 6 more via 8 more towards an Article 9 spirit. And the regulation is one thing. The regulation is also not perfect, but ultimately it's about the methodology that you apply. And for us here, if you will, the King's way, or the proper also scientifically sound approach, is always, when you look at an individual asset, to start with understanding the theory of change, to then look at a set of impact guidelines from intentionality, additionality, interlock, etc., and then ultimately look from a quantitative standpoint at the size of the impact opportunity in terms of truly modeling it and running sensitivity analysis and understanding. Is to say 5 million ton, speaking of carbon specifically, opportunity, or is this a gigacorn or gigaton opportunity? And so this, for example, we have always been open sourcing, and when you look at our AGM or our AENU summit, as we call it, we've always been inviting all people whom we collaborate with, even compete with, and throw GPs, LPs, founders, everyone in the room, NGO, academia, non-profits that are close to our heart, or where we put ourselves some of our private wealth. So we take overall, we take a very collaborative approach, and I believe also from a karma perspective and indirect impact perspective, the collaborative approach is superior to the aggressive and captive approach, which is, by the way, also very typical for the way the VC ecosystem has been or has developed in the past 40, 50 years. Is truly an elbows out industry
agree more,
between firms, but also within firms. And that's certainly also, from my point of view, one big contributor to all the mental health issues we see, especially also with junior and intermediate level professionals in VC these days.
Wow, there's a lot to unpack there. First of all, it's great that you're pushing for that spirit of collaboration. We'd love to explore more. Open sourcing is one way to do this. I wish everyone were just putting everything out in the in the open. Another one is those summits, where not only do you invite your peers, but also LPs. And as you say, there's always a fear as a GP, oh, wow, I don't want that LP that took us 18 months to lock in to land in the territory of our competitor, because it is a competitive funding environment, particularly for funds at the moment. Do you think the spirit of winning, meaning as a VC fund, you want to win sort of that battle to establish your bigger brand, become an Andreessen Horowitz or Sequoia? Do you think that's really what matters? Do you feel deep inside this kind of what the spirit of competition is what fuels most of the fund managers? Or on the contrary, as soon as they have the keys of the truck, the fund is operating, their future is somewhat guaranteed, and all they care about is impact? That's kind of the two extremes. Winning the battle, or sort of now I'm operating, that's all that I care about.
I think what I see at play in the mainstream of the emerging climate impact ecosystem, which is of course a friction of the alternatives investment universe. What I see at play is basically a mindset, and exceptions granted, but high level, what I see is a mindset that there can be fierce competition on individual transactions, but yet the dominating spirit, the way you basically the way you encounter each other as humans, and also as professionals and as people who share the same philosophy or the same point of view on what needs to change in the world and how we collectively as an emerging industry contribute to that, is where the collaborative element prevails. Yeah, and this is also what I experience and what I find okay in a day-to-day environment. I mean, in a given transaction, be it a seed and a Series A round, whatever, you cannot have more than two funds co-leading. You can have one fund being the sole lead, you can have two co-leading, you can have a lead and a follower, but there's no infinite room because we want to be respectful of the dilution for the founders and keep it in the low 20s and not in the high 20s or low 30s. And then when you look at fund models and make it work, and being respectful of the also not only impact returns but also financial return expectations of the LPs whose money we are custodians of, there are certain restrictions that we are facing, at least in the legacy 10 plus 2 year closed-ended fund model. Yeah, and this is where the industry is still stuck. And we have taken quite some steps beyond that at AENU, and have been looking and experimenting deeply into more long-term evergreen fund structures with very progressive elements, such as carried interest not being paid in cash anymore and extracted from the fund, but actually being paid in dilutive shares and compounding and lockups. So really like long-term incentive alignment. And this was when we were speaking earlier about the large structural deficits of VC, where I said lack of impact, lack of democratization, lack of stakeholder alignment in the long term, also lack of liquidity options is a fourth big thing that concerns me, and where my motivation is to contribute to the solutions to these four issues in the next years and even decades as an, again, entrepreneur in climate impact VC. These are all aspects of concern for me in that grander context.
I'll tell you what, I want to bounce on what you just said, and I do agree. I've been in the space about the same time, as you have, and I've observed a lot of a spirit of collaboration. And even though we're in a valley in terms of funding, it is difficult to lend LPs, to lend institutional investors, that can put on 20 million on the table, and they will not do it 5 times, they will do it once. You could expect a lot more elbowing, a lot more, and that's not really what I observe. I observe founders of funds that are trying to find a way to get inspiration from the others to succeed, but we're all kind of helping each other level up. And I think we collectively, if you speak to everyone, they wish the tap at the very top from governments, institutional funding was open much more. I think that's just what we need. We need hundreds of millions more. We need billions, really, to be invested more in funds. I mean, that every fund can grow faster and the entire ecosystem can, increase. And what the IRA, for example, in the US has done is an amazing green flag saying, we're going to fund whatever comes our way, as long as it's extremely innovative and extremely disruptive to solve the CO2 problem. And we haven't seen that level yet in Europe. I wish it was the case. Yeah.
And I mean, Ursula von der Leyen, so far, I think within her means and the levers that she can pull, EU Green New Deal, etc., has moved many things into the right direction. The European elections, of course, have been a setback more recently, and now Macron's move for re-election is a risky one. We have Italy already, so to say, in a right-wing populist
what can we say about the US if things swings?
Of course, Trump.
But we have a resilient space. I want to believe, I don't know what's your opinion there, if this space can sustain a winter. Or,
I mean, the space has already sustained the worst crisis in venture capital since Lehman, first of all, right? And we've been building anew, basically, in that crisis from scratch. So this has already been, let's say, quite a test for this first, let's call it the first generation of climate impact funds. Of course, a real test is going to start in 2 to 3 years when we talk about DPI. And TVPI, and when it's not just about raising a fund and showing
the actual returns,
right? Showing cash-on-cash returns that will compete with the generalist strategies, and where the proof has not yet been delivered broadly that these strategies can yield top quartile returns, and there are still, let's say, people out there also in the LP landscape that believe what climate impact is doing means sacrificing return or is closer to non-profit and whatnot. So it's on us to prove that you can deliver 15, 20, maybe 25% net IRR in such strategies and really operate at this intersection of high financial returns, market rate, top quartile financial returns, and high impact returns that are scientifically sound, proven in a strong Article 9 methodology. So this is a different debate, and we will have more figures to it from second, third fund generations when we speak again, let's say 2028 or 2030 at the latest. But coming back to your question, sustaining a political winter, or let's say a reversal or neutralization of regulatory tailwinds, I believe the approach that we take is ultimately a multi-century, but certainly even from a market opportunity, a multi-decade approach. And I think putting price tags on externalities is very, on the highest level speaking, what are the flaws of the capitalist system? This is certainly one of the very, very big issues that over the past 200 years, the traditional, let's say, Anglo-American style liberal capitalism has allowed many externalities to be unpriced. and this has basically contributed to the historically high wealth concentration that we have today, and many entrepreneur-led large enterprises being more powerful than entire countries and bigger than mid-sized countries' GDPs and whatnot. Yeah, so it is a world where power has been shifted from societies and even from governments to capital allocators and entrepreneurs, and especially organizations that are led by single people or owner entrepreneurs, founders, CEOs, and this is one thing we need to reverse, and the reversal of that with, for example, the European emissions trading system, also with the CBAM, carbon border adjustment mechanisms, etc. These are things maybe some governments will, let's say, decelerate or try to pause or whatnot. But I believe mid-long term, also when you look at the generational shift that is upcoming, I believe this is going to stay, and it is just going to increase in a sense that we will be closing more and more loopholes, not only on the carbon side. Biodiversity collapse is just next door. Yeah, water, sanitation, etc. So we live in a not just a decade, an age of poly-crisis technically, where the political, populist, and right wing and it's just one element, but there's climate and biodiversity and migration, etc. Also, cultural integration of migration in Europe is certainly something that has been carrying Le Pen's movement in France over a decade now, and that still remains unsolved technically. And that will keep us busy for the next decade or two. But in that spirit, coming back, so I am while there will always be tactical ups and downs, yeah, and one administration and one election here will be helpful and others will be less helpful. I believe the long term understanding of the Western and even the Chinese society and government, that we have an interest and a self-interest in the most egoist way you could think of to reverse ultimately, but first to halt the global warming and tackle the climate crisis. I think this is ubiquitous, and therefore from a zoom out perspective, I'm not concerned. But what we do avoid at AENU is investing into business models that are built on favorable regulation. So I think coming back now all the way to the micro level of day-to-day business, I think you do not, as a VC, you do not want to take, if you will, obvious regulatory risk in terms of depending on a subsidy regime or on an IRA, or for example, your whole business model. So we are seeking out those products and associated business models that may be accelerated with a favorable government grant or subsidies for exchanging your gas boiler for a heat pump, whatnot. Yeah, that may be accelerated, but that can still survive and yield economically sustainable, financially sustainable results, even in the absence of such a temporary or, let's say, tactical advantage.
I want to make a spiky comment here, and you're talking about the macro, and micro narrative here for climate. And do you fundamentally believe that hardware startups that require a certain, head start here to get going and to reach the right TRLs and level of maturity and then deploy wide globally, do you think that fits a climate tech VC fund timeline here of 10 years? Or is this a narrative that you're not fully convinced about? And that touches on the hardware versus software exposure as a climate VC fund. Love to hear your perspective.
Enjoying the podcast? Make sure you don't miss an episode by subscribing to our YouTube channel. Click the subscribe button now and stay updated with the latest in climate innovation.
So at AENU, we, from our current fund generation, invest 70% more on the software-led platform enabling maybe a dash of IoT side, and about 30% on hardware, where we typically are comfortable coming in at technology readiness levels 5, 6, not 1. Yeah. And this is for us reflective of the DNA and the circle of competence that our team has. Yeah. We come from an entrepreneurial heritage in the software-related industries. And this is where we are most value additive, what we understand best. Now, we also understand you cannot solve the climate crisis purely with software. So we need to expand the circle of competence by adding scientific DNA and being smart with a limited budget, limited payroll, being smart about how to go about it from there and whom to syndicate with. That may be coming like the engine from MIT or like SOSV, or, syndicating with partners who have a heritage and their core focal point in hardware and are very familiar with taking deep tech hardware development risks.
Is this ambitious enough to have 70% exposure to software?
I think the question is, what is realistically feasible for a firm to succeed? And having an impact means also succeeding in a market environment. And if we now, as people with a strong understanding of platforms, of B2B enterprise, etc., if we invest 100% of the fund in technology readiness level 1 deep tech hardware and fail at that because we're not proficient, because we essentially are not the best investors for that type of game with the DNA that we have, and sink LPs' money, then we neither have a lasting impact, nor do we do a favor to the development of our ecosystem and to making it more mainstream. But quite the opposite. We would actually foster the ideas of many legacy LPs out there that would say, "Oh, this cannot work," and you want to stick to fintech, to enterprise software in the traditional world. So it is not about whether we are ambitious enough. We are ambitious for our means, for our DNA, and certainly in Fund 2, likely these ratios will further shift. Mm-hmm. But it's a process of developing this DNA. And think Berkshire Hathaway, of slowly expanding your circle of competence and not stepping with 2 feet outside your circle of competence.
They have a certain style of investing, which is closer to private equity than to VC. And it strikes me, it's a great segue to the lack of risk-taking that I observe in Europe, for example, amongst fund managers. They don't often give themselves the means of their ambition. If the ambition is to have a tidal wave of impact and then to completely disrupt the industries and to migrate the incumbent, polluting industries into a green territory, do you think the strategy is sufficient? Do you think it's, to go 70% software and to say, first of all, we need to prove ourselves and then return LP money, or should we go somewhat all in because the fire is in the house?
I think what you say alludes to the general perception that the European VC ecosystem has always, in its 25 years history, been more risk averse, more, let's say, converging to mainstream, to groupthink, to herd mentality than the US ecosystem. And there are probably many elements catering to it. One may be, we spoke about it earlier, the fact that many US LPs are very accomplished, many US VCs are very accomplished entrepreneurs who are very wealthy, money behind the firewall. Now they want to play in VC. Yes, they have a reputation to lose. Yes, they have some of their GP commitment to lose, but essentially they are very established. Yeah. In Europe, we were speaking of career investors and people coming from other professional services. It's not the case. Everything for them depends on their career as VC. So it makes them naturally more risk averse than the type of, accomplished multimillionaire Andreessen or Chris Sacca or these type of people, or Bill Gates breakthrough, in the US ecosystem. And another aspect, I believe, also has to do with the LP universe in Europe that is much less dominated by private money than in the US, where endowments are, for example, a very strong supporter of the whole VC ecosystem. But here we are dealing much more also with sovereign-related schemes. We are also partially dealing with corporate-related money. Yes, there are family offices. Yes, there are some pension plans, but it's a different DNA, and it is in some ways also more restrictive to the GPs, and it makes the GPs more risk averse, in the fear of having little alternatives, sometimes on the LP ecosystem. So there's many elements coming together that make Europe a tougher ecosystem for moonshot bets, compared to the US.
I'm very glad that you point this out, and I couldn't agree more. I think the LPs, whoever is handing those keys to the GPs, are slowing things down, or at least they're creating a bit of friction. Do you think that's the case of AENU? And if you were just structured as a family office, you would have gone moonshot or at least taken more risk? But now the fact that you've gone the institutional route, accepting pension fund money or government money, ties you down. And what can we do about it?
So first of all, when you look through our portfolio with companies like Heirloom or Charm Industrial or Zero Avia, etc., so there are quite some hardware moonshotty companies in there. Yeah. So
from the early days.
Well, also companies that we follow on and continue to invest. Yeah. And Atmosero, for example, was an initial investment. We spoke about it, industrial scale heat pumps that we just did a good year ago. Yeah. So it is not that going the institutional route, in our case, was very little, almost no corporate money, but really mostly single family offices and institutional investors. It's not necessarily tying us down in that regard. For us, we like to, let's say, think for our own and come up with our own thesis. And we are very transparent to our LPs of what excites us and where we put research and where we're investing. But for us, the only limiting factor is really our own competence. What I said earlier. Yeah. And we need, whatever in the end the outcomes, we need to be able to step up in front of both the entrepreneurs and say, we believe we are a competent and value additive investor for you because we understand your technology, your industry, your competition, etc. And we have a certain, let's say, generic experience and understanding of the particular problems that you will be facing in 6, 12, 18, 24, and 36 months. Yeah? And we also need to be able to step in front of our LPs and say, we did this because, and we believe we are competent to do this because. And there are certainly, at a team of 10 or even 20 or 30 people, there are certainly inherent limitations. You cannot be in VC, you cannot be the jack of all trades. Otherwise, you end up in a, let's say, spray and pray strategy or passive investing, let's say ETF style for VCs, which is not our game. Our game is active investment approach, working on the boards and bringing essentially two core competencies to fruition. Also, if you were asking me what is our edge, why do entrepreneurs work with us? There's two core elements. One element is the entrepreneurial sparring and the operating experience that we bring to life and that we bring to the boardroom. Coming back to our early point about board composition and what is an ideal investor DNA and background. And this is not only from our core team, but there's also other unicorn CEOs and repeat entrepreneurs in our LP base that engage with these companies. Some are now even stepping up into venture partner roles. So the entrepreneurial sparring and coaching is an important element. And again, there are certain technologies, industries, business models where we are more competent and others where we're less competent. Yeah? And then the other key value additive item is what we like to refer to as impact as a service. Yeah, in the spirit of software as a service. So impact as a service is basically an unpaid offering or an unpaid, so to say, impact related services that our in-house team renders to the portfolio companies on impact measurement, on defining theory of change, on impact reporting, on life cycle assessments where there are hardware elements. We just conducted, for example, on a battery storage company, Second Life battery storage company from our portfolio. So impact as a service and entrepreneurial sparring as two key elements. And again, we need to play where we are competent, and you can and we can. We can expand our circle of competence or change, yeah. But this is nothing that happens overnight, and it's a top-down strategic move, and you need to fill in the blanks. You need to basically change your DNA as you go, as you progress. And this is exactly what we're doing. This is what we feel comfortable about, and we are glad that there are other players in the industry. I mean, you were speaking of Breakthrough earlier, Also, you had our colleague Sebastian Extantia earlier on the podcast, who may have a 90% or 100% hardware focus. Really, again, I think there's no right and wrong. Everyone needs to make their own best contribution, whatever that is, according to the DNA that they have.
And you mentioned something, it's kind of tying the whole loop that we discussed in this conversation. I appreciate, by the way, touching all those points. You mentioned that the quality of a VC comes from the brand, and the brand of the firm probably linked to the track record, right? And also being able to attract enormous assets under management, so big LPs. Do you think the quality of the VCs determine the quality of the startups, or is mainly about the founders themselves? So the VC at the end of the day is to source the best deals, the best founders out there. And in which case, do you really care about the value add that you can provide to them? You've been on both sides. It's a very interesting perspective you can have.
My conviction is that it is basically like a reinforcement cycle almost that is at play. What do I mean? When you look into the generalist VC world, a player like Sequoia sees the first level management dropouts from the top 30 companies in Europe. When these type of people start their own business, Sequoia sees that.
It will knock at the door of Sequoia.
Exactly. Before any continental European VC sees it. So they select from the best of the best in the talent pool as early as possible, as early as you can. And then they are not bad at adding value. Yeah. So again, what I believe is, or what my understanding, my analysis is after 15 years now in the tech ecosystem is that very good VCs tend to have certain sourcing advantages and tend to have certain very specific ideas that are sometimes also less opportunistic, less spray and pray, etc. That make it that give them an so to say a sourcing advantage, and these days increasingly also the tool stack and the augmented VC. I'm not saying necessarily AI, but some ML models, some scrapers, some smart crawlers, etc., contribute to that. Besides the people business, the personal relationships, and the brand maybe attracting, so to say, inbound these entrepreneurs. Yeah. So this is one part of the let's say of the answer, and again the other part is that some of these firms that have been successful for decades also have built really strong modes and playbooks that helps founders not step into certain pitfalls or derail unnecessarily, and are just good at extrapolating or in an abstract way, so to say, transferring knowledge horizontally across the portfolio, and also, if you will, vertically throughout time of past mistakes that don't repeat. Yeah. Right. So this is a mix of elements that work. But this is what I'm just talking about right now is basically the generalist VC ecosystem. In the climate impact ecosystem, the element of what, as I just alluded to, of impact as a service is a complete novel building block that none of these generalists brings. And for us, certainly, again, being true to your own DNA with the strong entrepreneurial and operating experience that we have across the team, core team, but also the satellites, this is something that we leverage. And where we feel also, let's say, with the case studies and or showcases that we've been building in the portfolio, where we believe we indeed have proven the value add that we promised, and also that we need to bring in order to, to justify our own existence. Because capital, just in terms of money, is increasingly a commodified resource in the industry. So the big question is always, what comes on top of the capital that is unique or that is differentiated from other capital offerings, and that brings the discussion to a level that goes beyond pre-money, post-money, dilution, drag along, tag along.
I wanted to contribute an anecdote. It was kind of funny. I was at this event the other day, and we were talking deal flow, great opportunities. And I brought up a carbon capture startup, and we're analyzing how amazing the team is, but there was clearly a gap in the founding team. And so as a VC, kind of thinking strategically, we're like, maybe we can invest in this company, help them develop the brand, so they can then attract the talent, the missing talent, to then carry on. And maybe our role as a VC, as a lead investor here, is to help them attract this key member. And then I was speaking to the founding partner of Index, who was in the room, retired guy, lovely person. And he said, we would never invest in a team that has a gap. It is not our role as a VC to fill this gap. And so I was wondering, it's a good point to meditate on. I was wondering whether they're in that position because they are Index and they will attract no matter what amazing deals with some of the top founders and then teams that are fully already complete. Or is it, did they become Index because of that philosophy? And so the chicken or the egg is always tricky. As you become an enormous brand and the game is set in generalist territories, I would say, both in the US as in Europe, it is not set in climate. We do not have superior VCs, of course. We have the breakthrough, lower carbon, but even them, they need to prove returns, and then there's a long way to go. So I would invite you, everyone, to meditate on that point. Is it the role of a VC to fill a gap or not?
So I think the answer depends on the stage you're investing. And when you do go to pre-seed, and there's one or maybe two people as one repeat entrepreneur that is trusted with you, and where you say, I want to back this person on this journey. For us, we are happy to accept that there's not a C-level team of 5 people that are each stellar in their field, given, again, pre-seed. Yeah? At seed, we have a tolerance maybe for one gap on the team. Mm-hmm. From Series A, it narrows down to almost 0. And this is my answer to it. And Index invests across basically all stages with different pools of capital. So when you look at a B round, for example, it would be very understandable from the answer from that founding partner. But for us, certainly it is very rare that when you really go pre-seed seed, that you already have a fully fleshed out team that basically stays in that composition all the way to, in the best case, IPO. Yeah. However, of course, the conviction that we need to have on the founder, or typically the 2, sometimes 3, typically not more than that, founders, and specifically the CEO, has to be extraordinarily high, because this is ultimately the person or the tech team that defines the culture. And as you know, as the saying goes, A people hire A people, B people hire C people. Once you deteriorate, so to say, the quality, you're doomed. Yes. And we have oftentimes seen AAA CEOs being able to hire very high quality people in the next 6, 12, 18 months as they needed to, and where announcement of funding round and being able to pay a bit more market rate salary, etc., certainly helped that. So as you say, de-risking the business, proving out milestones increases the employer, let's say the attractiveness of the employer brand and the ability to attract specifically seasoned talent. When they come from higher paychecks, they need to sacrifice. They may have a family to support. There's so many mechanics at play and life realities that you need to think of. Of course, it's easy to attract a 28-year-old MIT grad CTO that has a 0 cost basis. Yeah, it's much easier than to attract that 40-year-old 3 times as experienced CTO that has a mortgage to pay and 3 children to support, and where the wife says, "Hey, are you sure you want to go transition from SAP or even Celonis back into that early stage company where you take funding risk and whatnot." Yeah, but without drifting too far, we, specifically the way we work with entrepreneurs, are always happy to support in first and second level management hires. And that goes not only as far as suggesting talent from our network and connecting the dots, but also we interview. Yeah, and this of course depends on whether the CEO would like that support or not. You know, we're not pushing for it, but oftentimes we're actually asked by the CEO, I would value your opinion. Would you have 30 minutes? We have 3 candidates here now in the short list. And we want your opinion, which to pick and why. And also we want you to throw in another piece of weight and help us convince to actually also make those wins in the end. Yeah. So it's not a one-way street. And we happily do it. Ultimately, VC is a people business. Yeah. And we just take, just take joy in working and partnering and sparring with other entrepreneurs that are today in the shoes in which we've been several times, with failures, with successes, in this, circle of life, you could say.
VCs is a people's business. That means that we are humans. I would love to kind of end on this. How do you find happiness while watching the world burn?
So this question is almost coming back to I think your very first question, when you asked me how do you avoid burnout. Yeah? And for me, very briefly, with all the difficulties I also went through, or the challenges I experienced in terms of physical health and also slip discs and surgeries and whatnot along the way, but also with burnout situations that I've had in my professional career and high price I paid also in social life and friendships and relationships that basically I deprioritized for more than a decade for the means of pursuing my entrepreneurial goals and being successful in business, which now in hindsight, age 41, I have a more critical view, or I might have done some things different. I don't regret anything. Everything is, it's okay. But today, I'm able to reflect and to bring a bit of distance between my ambitions and my thinking and my, let's say, driven entrepreneurial high energy DNA. And the way I sort of say serve this, or how I ultimately act. And long story short, I've developed basically a daily routine that helps me sustain high level performance, but at the same time also physical and mental health, and strike a better overall balance in life. And this routine is basically composed of a daily physical workout, first thing in the morning, just like 20, 25 minutes. And it's a mix, whether I'm traveling or I'm at home, it's a mix of yoga, of jogging, just like TRX, body weight training. When I can, I swim, if I can, I surf. That is for me let's say the connection also to the element, the energy of the ocean, the single most important thing. But unfortunately, I live landlocked in Hamburg and my office is in Berlin. Yeah, but that's fine for the time being. So a daily workout routine plus a several times daily meditation routine, where I started out 5 years ago with an Indian school, transcendental meditation. Did that for a year and a half. TM, exactly. And then by chance, a friend of mine who became a Buddhist monk in the Corona years, moved permanently into a monastery, and then had a chance to basically get in touch with traditional Japanese Zen Buddhism, and immediately related to it and switched. And ever since, I meditate minimum twice, usually 3 times a day. Also very early morning when the house is still asleep, kids are still asleep. Then briefly right before lunch, empty stomach, just like a pause button. Had already 4 or 6 meetings. A pause button before lunch, and then in the evening, typically right before dinner, again empty stomach, and starting to wind down. And this practice, where I also go typically once a year, I go to the monastery for a 5-7 day retreat. This gives me a much higher level of clarity, finding silence also to stop the flywheel,
the crazy grind,
the crazy brain, the inner voice. Yeah, it gives me much more focus, and even I observed a higher baseline of joy in life and of gratitude, but also of compassion for the people, the planet, basically for all beings out there, and a different understanding of how everything is connected.
And it's so important. It's so important to pull out. And we can have very strategical conversations about VC. At the end of the day, we're also doing this to preserve the people, right? The essence of our society. So thanks so much, Fabian, for coming on the show. It's been very insightful.
My pleasure, Johan. And thanks for having me again.
Take care. Bye-bye.
Bye-bye.
Ready to make a substantial impact on our planet's future? Join the Climate Insiders community today. We are a group of investors committed to supporting bold, moonshot startups that are tackling climate change head on. Become a part of a new generation of climate investors and help us create a sustainable future. Visit climateinsiders.com to join now.